Welcome back, traders. In today's video, we're going to be discussing the code to consistent trading. If you haven't already, please leave a like on this video to help out with the algorithm. Also, go ahead and subscribe to the channel if you haven't already. That way you can get our future videos whenever they're released. Also, if you find this video helpful, and if you think a friend may benefit from it, please go ahead and share this video. Now let's get right into it. Welcome to the Option Trader Lounge, where we talk about generating income and growing your wealth within the US stock market using options. Thank you all for tuning in. Get yourself a drink, sit back and relax. Now let's get into it. Now, consistent trading is what many traders strive for. It is one of the most difficult things to achieve because trading is not easy. But if you follow these few things that I'm about to share with you, you can develop a framework that allows you to have consistency in your trading. Trading is not easy. Running a business is not easy. So what makes a successful business successful? Well, there's many factors when it comes to success in any business. And trading is the exact same way. It involves capital, it involves discipline, it involves hard grinding, effort and work, sleepless nights where you could actually learn the craft, improve on your weaknesses, and maximize your potential. We need to understand that trading is a long-term approach. This is your business, and anyone who gets into business does not do it for the quick buck. They're in it to create consistent cash flow that they can rely on, cash flow that can pay out their employees, their family, and to create a lifestyle of success. If we take the long-term approach, then it will cut out all of the false truth about trading. Trading is not about turning 500 into 5,000 in one trade. That is not trading. Taking the long-term approach means that you can create consistent income that you can rely on day after day, month after month throughout your years, right? So when it comes to trading, the most important thing you have to do is to stay focused. To stay focused to one strategy and master it. The problem that we see a lot in trading is that there are so many traders that are out there that first start out, and hence the reason why you need to stay focused. Many traders start off with a small account, and it could be anywhere from 1,000 to 5,000 to 10,000. Those are all small accounts. And if we understand this, that diversifying across many strategies in the beginning will put your account and your ability to continue to master the craft, and it'll put it to jeopardy. Because the more you're diversified, the less you can stay focused on what needs to happen in terms of developing a good trading strategy and to develop a good trading mindset. If we can stay focused to one strategy and learn it, whatever it is, if it's a dip buy strategy, if it's a breakout strategy, if it's a consolidation retest, that needs to first take place in anyone's trading journey. To focus on one strategy with the limited finite resources that you have when you first start trading. And the whole goal is to stay focused and to build that account up so that way you can diversify into other things. Once you get good at one thing, then it'll allow you to free up your capital to be able to test out new strategies and expand and build your overall framework of what it takes to be a all-star when it comes to trading. So what does that look like whenever we are first getting in? So what I have here is a risk reward ratio to a win rate chart. We do not want to be in here where we have a low reward and a low win rate. Profitable trading comes when you have a high reward trade setup and you can possibly have a low win rate. There's ways to do that, right? You can create profitability in this way. You can also create profitability in your account if you have a high win rate but a low return. It's more about getting the reps in, right? Getting the small wins and compounding it over time, as long as if you know that your strategy has a high win rate and high enough to where it could absorb the losses. But the magic happens when you have both. See, when it comes to this chart, we can understand risk reward by the simple risk reward ratio. You could either risk 1 to make 3 on a risk reward ratio, meaning that you're risking $1 to make 3. That's one way to do it. You could also have a risk reward where you're risking $3 to make 1. But in this scenario, you're going to have to create a lot of reps for it to be profitable. And whichever you choose, as long as if you're sticking to a system that actually works, right? As long as if you're not style drifting in terms of the different strategies that are out there, there's a plethora of strategies that anyone can trade off of, right? But the problem comes when you're unfocused and you're not sticking to a strategy to build your account up to be able to diversify and test other strategies. So we know that losses when it comes to trading is a crucial thing that we have to consider. Trading is not trading if we do not accept losses. There's no such thing as a trader who does not take losses. We have to remove that expectation that every trade we enter is a trade that we will win. If you live off of that philosophy, you're bound to lose because the market is a random event, right? Price movement can change in an instant, and we as traders who have small influence on the overall price of a stock or ETF or the market, we cannot move the market with only 500 shares. The ones who move the market are the institutional investors who have the large capital, as well as the institutional investors who run off of algos in their trading system. They're the ones who move the market. Our job as retail traders is to manage our risk, right? Our job is to identify possible high win rate, high profitability setups where we can enter in and profit off of a move. Our job is not to influence the direction, but rather pick risk reward setups that are favorable and enter them when our signal hits. And as soon as we enter it, we switch our mindset into the risk management scenario where we take the losses when our stop losses hit and look for the next opportunity once we take that loss, right? The whole goal is to reload and rinse and repeat. This is a very crucial chart. It's called the break-even chart. So on this break-even chart, what it's basically telling us, the amount percentage return that we need to make with our new account size, considering that we have a 10% drawdown or 5% drawdown, it's going to take us a 5.3% move to break back to even. So let's say we have a $10,000 account and we take a 5% loss. Our new account is 9,500. To go back to break even, we need to make a 5.3% return. So with our new account of 9,500, to go back to break even, it's going to take a 5.3% return. And now we're back to break even. This is crucial because the bigger your loss, if you look at this chart here, the bigger your loss is, the more of a return you're going to need to catch up. And so limiting your loss is a part of the game. Limiting your loss is a part of trading. And if we understand that as traders, we can understand the importance of a stop loss. Trading is about probabilities. And if we understand that, then we can learn to take losses. If you run a trucking business, how stupid would it be to say that, you know what, I just want to make all the deliveries, but not pay any gas. That is stupid. No business operates without expenses. And the whole part of a trading system is to understand that you have the potential risk and you have the potential reward. And if you don't consider the risk and all you're considering is the reward, then you're tricking your mind to think that there's no risk at all. The market is not going to make money for you. You as a trader have to understand that you make the trades and therefore you have to manage it. So how do we test a trading strategy? Well, the best way to do that is to trade a large enough sample size. Whatever strategy you choose, whether if it's a breakout, a dip buy, a consolidation breakout, a retest, whatever it is, pick one strategy and spread your capital into 20 trades. So let's say, for example, using a $10,000 account, we want to trade a large enough sample size. And we want to divide this $10,000 into 20, meaning 20 different trades, meaning that your max loss is going to be 500 bucks on any trade that you take. If you do this, you can get a good feeling if your strategy is actually working. The problem with most traders is that they risk their whole account size in one strategy without testing whether or not if it works. And if the moment they do one strategy and it doesn't work, they're immediately testing out another strategy. Whether or not you made money on the strategy that you are testing does not mean you are right. Even if you lose, it does not mean you're a loser. All that it is that the strategy itself is playing out its odds. You do not have control over whether or not a strategy makes you money. Your goal is to identify the pattern and trade its probabilistic edge. That's all you have. So we have to understand that when we trade a large sample size or any trade that you get into, we have to trade without expectation to win. And ultimately, we need to focus on the process because the process is what is going to make you a consistent trader. We should not be thinking about whether or not how much money we will make. The goal is to create a systematic approach to trading. And so how do we determine what pattern we'd like to choose or what strategy we'd like to choose? You could honestly find all of the different strategies that are out there. It's more of a matter of your desire to be disciplined. Having a disciplined approach when it comes to trading is the most important thing if you want to succeed in this business. There are going to be times where you have a winning streak. There also is going to be times where you have a losing streak. But if you do not have that discipline, you could either be euphoric or you could put yourself into a mindset to quit. If you become over euphoric, you can force trades and you could totally jeopardize your account. Doubling down when you shouldn't be is a big mistake when it comes to a disciplined approach to trading. Likewise, if you enter into a losing streak, it could force you to deviate from the strategy and find a new approach. So learning to be disciplined is the key to the game. If you can learn to focus on one strategy, you can learn to play to your strength and work around your weaknesses. And at that point, you can allocate most of your capitals to an effective system rather than spreading it across multiple systems that are delivering poor results. So that is the whole idea of developing a disciplined approach when it comes to trading. It is the most important thing if you want to succeed in this business. And so if you enjoyed this video, please go ahead and like this video. Also subscribe to the channel. And if you know a friend who may benefit from this video, please go ahead and share it. We would greatly appreciate it. Once again, thank you again for tuning in to the Options Trader Lounge. We will see you on the next one.